Hi guys, welcome back. Remember back a few months ago in my video, I have used the picture of the real estate map to be the example of the order how different stocks usually grow. The order of them starts usually from the FANG stocks. That would be the city center, the downtown area. They usually grow first, and then after that, the really fast growth, the popular medium caps like Palantir, NEO, for example, and then the larger caps, steady growth like the Nvidia, Qualcomm, for example. Next is the popular medium caps like Palantir and NEO, for example. Next would be some smaller caps and popular ones like NNDM, BNGO, for example. And then only the last, it would be the lesser known smaller caps like EH, AKB, LKCO. Less known, less popular. So in a bull market, a healthy market, that's usually how the order would take. This video was back in April, and I think it's still true nowadays. Now, if we use it to apply to the Chinese stock market, it's the same thing. The FANG is the BAT, Tencent, Baidu, Alibaba, Meituan, JD, etc. And then the bigger caps would be like Xiaomi, Bilibili, VIPS, and so on, just usually how it should roll out. That's why I pointed out the market dip was the gradual rotation from the previous hot growing stocks into the others that's long corrected with strong fundamental, such as the Chinese big tech. So I thought that would be the next group of stocks that would be leading the growth. They were mostly beaten down by policy and still have good growth rate and good fundamental to support the share price, and yet got somehow even bigger dips than the smaller caps. On October 15, I talked about Baidu, said many Chinese big techs have formed a good bottom. 2 weeks ago, I said when the US market start to correct, the Chinese stocks would follow with a dip. It could make double bottom or not, but maybe not make a new low. And after that, the previous long corrected Chinese stocks, like the undervalued big Chinese tech, might make better recovery. And then again, I said, I think this is the period when institutions have slowly been accumulating. And the priority would be the big techs that have lower risk with the cheap valuation. Like these, and you have seen this recovering earlier than the rest, especially like JD, Meituan, BYD. So I think this is the order you can take a reference to and keep in mind, unless there is short-term stimulus, like the company announcing something or the earning. That would be the short-term catalyst to give the share price a boost. So right now, to look for short-term opportunities, I think we can take a look at the earnings. This is the earnings schedule I've captured for some of the stocks that I have been watching or own. You can screen cap that if you also have interest in these stocks. Pay attention that if the earning is announced during the pre-market, I would usually put the date a day earlier. Now, obviously, I don't plan to cover everything here because there's no time, and also I won't repeat what I've covered recently. So I'll just cover a few like ZEPP and CAN because I haven't covered them for a while. Idex, I said I would do a video on it and I haven't. And Baidu, YSG. First is ZEPP. ZEPP is a company that I have been holding since the end of last year. At that time, it was still Huami. They haven't done the rebranding of ZEPP yet. And I gotta say that since they have done the rebranding, I like this company more and more. Because of the new focus of the future of health, the refine of the strategy to be into more a health tech company instead of a smartwatch company. Follow with the series of moves like the new acquisition, the investment into different companies, the license given to the Chinese company Yitong High Tech, so then they can work with EV brands and connect the wearable device to the car. This drove up the Yitong's share price so much because it's a great business, definitely in line with the trend for the future and my vision for the company, how it plays out to the future life and the smart cities. The new product they have announced in July, having more R&D, more invested, more technology into the health tech. First company to develop a portable MRI machine, first smartwatch that can test blood pressure. So I think the fundamental of the company is getting better and better, but a lot of the good news have not resulted in the share price yet. So I'm still very excited for ZEPP. I think once it wake up, it would be on fire as well. So I'm not worried about this. Now for the earning quarter by quarter, we just have to keep monitoring the margin rates, because technology company would have much bigger margin rates than the smartwatch manufacturer, which were what they were considered before. So on the transition to be a health tech company, they should slowly increase the margin rate. Doesn't have to be the profit, because I assume they would continue investing more into R&D. So margin rate and also the product they sold with their own brand. In terms of the share price, back to the list I gave out in early October, I said I would add more ZEPP if it reached to 8.3. And we see the lowest with this recent correction, it got to 8.2. So once I hit my target, I have added more on my ZEPP position. Next is CAN. Recently, CAN had been growing very well, breaking down this trend line, right now consolidating after the breakout. So I think it's definitely interesting to look at. It was heavily beaten down because China was banning more of the crypto mining activity. And a lot of blockchain companies need to move out of China. They won't ban the business of CAN to produce mining machines, but it would indirectly affect them. One of the reasons would be, like, for example, a lot of the miners need to sell out their equipment secondhand. So there would be certainly some more second-handed machine available on market, and it would affect their sales. But I think that had passed, and the bad news had been priced in their share price enough already. And even though CAN had not grown as much as the other non-Chinese blockchain companies in the same sector, same business-wise, fundamental-wise, they are still ranked one of the top in the world in this field. So I think short-term catalyst is that more and more blockchain ETF would be established, and they would buy into shares of CAN automatically. So it would really increase the demand, as I think more and more financial institutions, investment firms would start to have blockchain ETF soon. In August, CAN had announced to appoint a new CFO who were the vice president for Zhaopin.com. It's a very well-known company in China. So I think for him to move to CAN to be the CFO, I consider this good news. It shows good growth potential for the company. Outside of China, a lot of new blockchain companies are being set up. So I think the business for CAN for the near term and for the near future shouldn't be bad. Next is Idex. All these companies reporting earnings on Monday after market close or Tuesday before market opens. So Idex is like a brother company for LKCO, and similar style, they also have acquired a lot of the new technology companies. One of the most important one would be Wave, the wireless charging company in US. I think this project looks quite interesting if they can get this wireless charging system rolled out. Another important one is the Malaysian EV manufacturer called Electric. I think this is also the big growing factor for the company. You can see their products, they call the e-bike, and I think their main market focus right now is in the South Asia. The new scooter has been growing very well, and we'll see if the Electric can take a little cut from NIU, because NIU has been growing, expanding very fast in the recent 1 to 2 years. So that is earning to watch out for. Next is Baidu, earning on Wednesday before market opens. Fundamental-wise, Baidu still has one of the leading technology in autonomous drive. They have the top ranking, passing Waymo in terms of the MPI, which is miles per intervention. So technology-wise, Baidu is definitely one of the key players in the world. But in terms of the company's revenue recently, I think there is a big factor we need to watch out for. It is the advertising business for them. As we know very well, the fall of the education kingdom in China means a big part of the marketing fees are cut completely. And education sector's marketing fees plays a very important role in the whole marketing industry. So that means I think Baidu's revenue might result in that too. If Tencent's earning can have a miss, partly driven by the advertising business, then I don't see why not for Baidu. So that's something we need to watch out for. But regardlessly, I think if the first fall from 300 to 170 was driven by the margin call accident happened in March, then this fall from 200 to 130 at some point, I think that should have priced in the fall of the advertising revenue for Baidu. So I think Baidu is still on the way of recovery. If there is a dip driven by the earning miss, it might be a good opportunity to catch. IQ and Baidu are reporting earnings at the same time. These two have very strong correlation as it's owned by Baidu. So that's why just reference to Baidu for trading strategy. And next is BABA. Because I have updated BABA for so many times already, so I won't get too deep into it. I suggested to take profit at 182, bought back at 163, and call option at 158. Right now, the support is at 163 to 165. So just find the dip to buy. I think it should be okay. Next is JD.com. I suggested to buy at 76, 77. We have a great run up, and in my last video I said it's not over yet, as my short-term target is 87. For more, you can refer to my last video. Now I want to talk about YSG. Why did I give a buy-in order for YSG at 2.8 when it was at 3.3 at that time? And after all this for the last few months, I did not start my position again in YSG. I think the big fall was driven by a few factors. First, the lockup period finish. It would drive the big investors previously and the management or some of the founders sell off. And then later there was one of the three first founders leaving the company. That is not a good news for such early company, and also it would drive a large chunk of shares being sold. And then the last earning was a miss as well, because it shows the company is starting to slow down. So why did I take a position at 2.8 after all of this? Well, first of all, the earning call last quarter shows that the management had faced the problem the company was having. They realized their mistake on putting too much effort on the new brands instead of the main brand Perfect Diary. And this is why competitors started to catch up. At the same time, a lot of the foreign brands, the big brands like Estee Lauder, L'Oreal, started to have heavy exposure, putting more efforts onto e-commerce platform because they realized they were losing market shares to companies like YSG. So that contributed to the fact that YSG was slowing down last quarter, or maybe the one before as well. So I think it's good the company realized the problem and started to put more efforts back to Perfect Diary and have started to look for more solutions, more ways, and more network expanding for advertising or marketing to Douyin or TikTok. And I think it will start to result in the future earning, whether it's this one or next one. At the same time, I think they're having faster growth in the skincare product brands also. I have clients into the skincare and makeup brand, and they told us that the skincare overall in China right now is growing very well. So I took a position. If it have another missed earning and drive down the price to get another dip, I think I will continue to average down, like at around 2.2 to 2.3 if it gets there. But I think overall the company's valuation has gotten to be very fair value. They're still holding quite a substantial amount of cash that would allow them to grow and market the brand. The management team is still very young. They've got a lot to learn and improve. That is understandable. But I think I would prefer a young team more than a mature company because it has more room to grow. They can make faster decisions. They can catch the trend better, faster. And compared to older brands like L'Oreal and Estee Lauder, new brands have a lot of advantages as well. They don't have large network of distributor that they cannot change strategy, change product line easily. And they do get price advantage because of that. And in the long term, makeup industry would continue growing fast in China, just like the coffee industry. It has been very mature in the West, but not so much in China. Still a lot of room to grow. Chart-wise, we have been having MACD divergence for the last few months. So I think the reversal might be just a matter of time. From the weekly chart, you can probably start to see the more it drops, the more the volume increase recently. So I think the next 1 to 2 earning would be quite important. Maybe especially the next earning, because we will see how well they perform for the Double 11 day event a few days ago. I wish I could share more of the stocks having earnings soon, but time is ticking, so I would quickly move on to some of the questions on the Discord. First, comparison between LKCO and NavInfo. Recently, the NavInfo has been growing very well in the Chinese market, in despite of the Shanghai Composite's correction, near 40%. So we should be wondering why is LKCO not following, as they're in the same sector, but NavInfo is the leader in the HD map field, taking most of the market share, and Imago takes number 3. And as our member pointed out, Volvo Car chooses NavInfo for V2X service in the next 3 years. Volvo is owned by Geely and Geely invests in LKCO. So why is Volvo choosing NavInfo over LKCO? Well, this question is similar to the question of why Geely was working with Baidu instead of Luoquang, which I have asked during the last interview. And the answer was that Geely has many divisions, many sub-brands, and they have their own right to choose their own suppliers. So whether Geely invests in Luoquang does not affect how all the sub-brands choose suppliers. We know that Volvo's Zenziac, the autonomous drive software team, chose to work with Luoquang. So why do they not choose NavInfo? It should be the same reason. They all have their own freedom to choose their suppliers, and it's normal for a company to not choose to put their eggs in one basket, but have many different suppliers instead. This way, the suppliers get more competitive, and the company can get more sources of technology, of talent, etc. And this industry is so early and growing so fast. I don't think we need to worry that one competitor is growing and would take up all the market share, but instead be excited that the industry might be receiving the prime time ahead once it starts to grow. It's the whole sector, the whole industry growing. And again, compared to the market cap, NavInfo is worth 5.3 billion US dollar, about more than 12 times than LKCO, so we can do the math. Concerning upcoming NEO Day, do you have trading strategy for this or just diamond hand? For my prediction of the NEO's price movement, I think you can to my video on Tuesday. I have analyzed the institution cost for NEO and the expectation to NEO Day. So that would be the short to medium term price prediction there. For the long term, I think I would diamond my shares. But for the short term, I don't mind putting options here and there. I think 2 to 4 weeks before NEO Day, institutions might accumulate more shares towards the NEO Day event. And depends on the amount of good news announced, we will see the result, whether after NEO Day it would be a sell-off or triggering more buy-in. Next, can you review BTB? Why it has grown to 130% in last 1 week? So this is a tea beverage company located in Changsha, China. IPO at 11 in 2019 and then fell after that from 27 all the way to 74 cents a few months ago. And now there is a huge rally. Well, just look at this volume. Compared to the past, I think the volume this week is more than the past 2 years. So very clearly the institutions had finished accumulating their shares in the past 3 months. And this rise in this week is an invitation for the others to join in the party. Now, the total market cap is 130 million, so it can be easily controlled by just 1 or 2 institutions. So it's risky, but it's up to you whether you want to take a bet, because it would be very volatile for sure. If you are lucky and you buy now, you probably can buy high and sell higher. But the stop loss is very far away. Stop loss at 2, that's the first support. So you're risking quite a bit with this trade here. Do I think Lucid would reach a market cap of 100 billion before NEO? Right now Lucid is 71 billion and NEO is 69. Well, I think NEO's fundamental is stronger, and in comparison, NEO would be a much more fair value, a much better deal right now. And if there is a big correction coming on the way, which one do you think has more room to drop? In the past few weeks, maybe Lucid had better performance than NEO, but again, we cannot use the past performance to predict the future. Maybe in the next following period, NEO would have better performance. Who knows? Would you agree that the market is just one giant Ponzi scheme? Well, hasn't it always been like this? Large institutions, large hedge fund, they have way ahead of information than retail investors. They can have many ways to manipulate the share price, the psychology. It has been like this for decades and centuries, isn't it? So if we want to be part of the game, we just have to accept the rule. And it's more obvious for smaller caps. And I think to invest in stock market, it's impossible to try to time the market, to try to predict the future, or try to time the crash as statistics proven that it never works, and the return on investment is actually lower to try to predict the crash. So that's it for today. I hope I got everything covered. And if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.